$22 per hour. That gets us 66,220. Now let's calculate the standards. Standard quantity times the standard price. Now at our standard is, we expect 4.8 standard hours per anchor, and we know that we produce 610 anchors. So we would have expected, our expected total hours would have been 2,928 hours times our standard per hour price of $22 per hour, gets us to 64,416. All right, at that volume, that's what we would have expected to pay. But if you let's look at the variances. It says Round Belly experienced a favorable price variance because it paid employees $1,432 it paid $1.43 and some change, but it paid the employees $1.432 less per hour, and so that's why we had a favorable. And then Round Belly experienced an unfavorable quantity variance because it produces 610 anchors using 82 hours more than the standard expected. So it's kind of the inverse of what we saw in the middle here. So we paid our employees a little bit less, but it looks like it took them more time. So, you can assume that, okay, you're paying someone less than you would have expected. So you're probably, is someone not as skilled, they're probably newer, because we're paying them less. And so it took them longer. So we had a favorable price variance, but we had an unfavorable quantity variance because probably someone not so skilled it took them a little bit more time, which is kind of the inverse of what we saw here in the green on the Vlyfest. All right, let's go down to the variable manufacturing overhead. We got HMS Round Belly Inc. has the following variable manufacturing overhead standard to manufacture one steel anchor. It's the same 4.8 standard hours at a $6 per hour direct labor rate. Last week, same thing, 310 hours were worked to make 610 anchors, and the total variable overhead cost was $18,985. All right. So same thing, let's put it into our formula. We take our actual quantity, we know our actual quantity, the actual hours were 3,010, and then we're going to calculate what our per hour variable overhead rate was, because we're going to want to calculate that and then compare it to the standard. So we take our total cost divided by our total hours, that gets us the 6.3073 dollars per hour, and that gets us back to the total cost, which was the $18,895. And then we take our actual quantity times our standard price, and we know our standard price is $6 per hour. We know our actual quantity is 3,010 hours. That gets us to $18,060. Now we take our standard quantity times our standard price. That's 4.8 hours times the 610 anchors, because at that volume, at that number of anchors, at 610 anchors, we would have expected this many hours, right? So we multiply that, we get 2,928, similar to the box above, and then we multiply it by our standard price, and the standard price here is $6 per hour, and so we got $17,568. That's what our standard would have expected. So let's analyze the variances. We see that Round Belly experienced an unfavorable variance because its actual overhead rate was 0.3073 more, right? And when we did the math, you can see that from the expected $6, well, the actual was 6.3073, right? Almost $6.31. Now, Round Belly experienced an unfavorable quantity variance because it produced 610 anchors using 82 hours more than the standard expected. So those are our material labor variance and variable manufacturing overhead variance. I strongly recommend, when you get one of these problems, you set it up in these boxes, and you do the formulas this way. Take your given information, break it down, come up with your actual hours or your actual quantities, and you get a per quantity or a per hourly rate or a per quantity rate, and then it's easier to analyze if you break it all down. Anyway, watch these overs again. So that this mechanically makes sense, but that's how you do your materials and price variance analysis. Now let's look at some different type of analysis. Over here on the right, we got these purple boxes. the one in the middle, it says variable overhead spending and efficiency variance example. All right, so HMS Round Belly Inc.'s actual production for the period required 16,000 standard machine hours. Actual variable overhead incurred for the period was 62,860. Actual machine hours worked were 16,300. The standard variable overhead cost per machine hour is $4. All right. So if you remember on the other side of the cheat sheet, we had our formulas for doing our variable overhead spending and efficiency variances. So the same thing that we did similar to our price and quantity variances, let's put it into the form. Let's write down our formulas. Let's put our given information in the formulas, and let's figure out what our variances are, and then explain our variances. So the spending variance formula is actual hours times actual rate subtracted the difference between the actual and standard rate. So our actual hours were 16,300, and the actual rate, well, we need to figure out what our actual rate was. So we take the total cost divided by our total hours, and we get the actual rate was $3.86. Now our standard rate was $4. So we take our actual hours, the 16,300, times the difference between our actual rate, our actual rate and our standard rate, and we come up with a favorable variance of 2,282. All right. Now, let's look at our efficiency variance. So that's our spending variance. We had a favorable spending variance. Let's look at our efficiency variance. So we take our standard rate times the difference between actual hours and standard hours. And we know our standard rate was $4. We know our actual hours were 16,300. You know, our actual hours 16,300. Our standard hours were 16,000. That's in the given information. Now we take the $4 times the difference between our hours. We get an unfavorable variance of 1,200. The total, when you combine those two, that's our total flexible budget variance, and we saw that is a favorable variance. So let's read what we have here. It said Round Belly experienced a favorable spending variance because its actual variable overhead rate was 14 cents less. We saw that. Than the standard. All right. Round Belly experienced an unfavorable efficiency variance because it needed 300 more machine hours than the standard expected. The total flexible budget variance is favorable as the result of the combination of the two. All right, that's pretty straightforward. Just know what the formula is. The formula is a little different, but that formula is given on the other side of the cheat sheet. And when you're looking at a variable overhead spending and efficiency variance, that's the formula you want to use. Now, let's go down to the bottom, and we've got our fixed budget variance. So we've got our flexible budget variance. So we've got some given information in this. Well, let's read the given information. Then we've also got this prepared budget. So it says HMS Round Belly Inc.'s actual production required 21,400 standard machine hours. Actual fixed overhead was 14,750. The predetermined overhead rate is based on 20,000 machine hours. Okay, that overhead rate is based on 20,000 machine hours. If you come over here to the left, we got this box above it. It says assume the flexible budget assume the following flexible budget prepared with direct labor hours at different volumes. Okay, so management at Round Belly prepared this budget. We got direct labor hours. We got different levels. Remember, a flexible budget has different. It's got our variable costs and our fixed costs at different volumes. So we've got 15,000 and 20,000, 25,000 total variable overhead. That's just a multiplication of the variable overhead rate times the direct labor hours. Then we get our total fixed overhead is 14,000. If you flip the cheat sheet over at number 3, you'll see that this budget is the same that we have prepared on the other side, but we just broken it down here, and we're coming up with a fixed overhead rate. Now, our fixed overhead rate, we can see it's different at different hours because our fixed costs stay the same. But the fixed overhead rate, we take our total cost and we divide it by our number of hours. And remember, going back to lesson 1, when we're talking about a fixed cost has this sort of S, or not S, but it's got this curve to it, because as you produce more units, or as you get greater volume, the fixed overhead rate decreases because that fixed cost stays the same, but as your units go up, fixed cost per unit goes down. And so this is our fixed overhead rate, and you see that it's decreasing as our volume decreases. That's what we would expect. All right, so let's go into the box, and this box and this formula you have on the other side of your cheat sheet too. This formula is pretty straightforward. We just take our actual fixed overhead incurred, which we know was the 14,750 that was given. We take our denominator hours times our fixed rate, and we know our denominator hours were our actual hours, which were the 20,000. The predetermined numbers. Okay, so the 20,000 is what we came up. That's the denominator hours is what we used to come up with our rate, right? Which was the 20,000 times the fixed rate, and we know that's the 70 cents that we got here at 20,000, which obviously that's our fixed overhead budget is 14,000. So the 14,000 is there, and then we got our fixed overhead applied, and so we take our actual hours times our standard hours times our fixed rate, and the standard hour. Actual production required 21,400 standard hours. Okay, so the standard hours were given, and so we put the standard hours in the formula. It's the 21,400 times our fixed rate. Our fixed rate is the 70 cents. And so you'll see here at the analysis says Round Valley experienced an unfavorable budget variance because its actual fixed overhead was $750 more, right? We expected 14,000, but it was 14,750. So that's an unfavorable variance. It was 750 more. And then we say Round Valley experienced a favorable volume variance because it needed 1,400 hours more than the standard expected. So we had our fixed rate at 70 cents, which was based on 20,000 hours, but our actual standard hours were 21,400. So as you remember, as I was talking about before, as your volume increases, your standard rate per hour decreases. So we were basing this at 20,000, but it was actually 21,400. So when we multiply those, we get a favorable variance because it comes out more than what we would have expected, right? So we produced more at a lower fixed rate than what we were expecting, which was the 70 cents. Okay, so that's lesson 8, standard cost system. Watch this over again. Go through the problems. Remember, the best thing to set up when you got a standard cost variance analysis problem is put it into these boxes. Break it down, get your hourly rates, get your per unit rates, do the variances, come up with a favorable, unfavorable. Remember, the equations on the other side, if you have a negative, it's favorable. If you have a positive, it's unfavorable. And when you're doing the journal entries, a favorable is going to be a credit, and an unfavorable is going to be a debit. And then the rest, you'll see, it's just going to fall into place. Follow the journal entry setup, and you'll be able to solve any problem in your homework. That's lesson 8.